Hello and welcome to a brand new show of Market Makers. We've just put a very heavy news week behind us. Union budget is over, RBI commentary has been analyzed, and eco survey has been tabled. So what is the next big trigger for Indian markets? To discuss that on this edition of Market Makers, I have with me Pathik Gandotra, Head of Equities with IDFC Securities. Pathik, always delighted to have you back on ET Now. Thank you for joining us. Let me make my introduction as my first question, which is, what is the next big trigger for Indian markets now?
So I think the next big trigger is when RBI starts cutting interest rates. It's like almost been like waiting for Godot, and I think what's going to happen is that if you read RBI's commentary the moment after the budget, they said they're happy with fiscal consolidation, and if you read their commentary just before the budget, they had said that once they see signs of fiscal consolidation, they will go and cut rates. So I think the next move will be RBI will cut rates in April, and that will be a push to interest rate sensitives. So the next move I think should be upwards.
So far this year, liquidity has surprised us. Do you think now earnings could also surprise us?
On the upside?
On the upside.
I think only in a few sectors. I will not generalize that for every sector. I think, for example, in banks, you'll see earnings surprising you on the positive, because what will happen is that the provisioning cost that analysts have built into their numbers for next year, I think will surprise. We've been saying that since a long time, that we think asset quality concerns are obviously overhyped. And that you will see from the next year when you see provisioning costs not rising enough as people expect, actually even falling, and that will be a big ticker to bank earnings. That's one. Two, I think while IT sector earnings will disappoint in the near term, I think towards the end of the year you might even start seeing an upgrade cycle in technology stocks, because with the US economy recovering, Europe almost at least out of the woods for some time, you will see IT spends pick up, and obviously it will impact the dollar earnings of these companies.
But most of the IT companies are still of the view that the springtime is over, environment is challenging, and the budget spending commentary which we've got from Infosys and from Wipro is not all that strong. Is not rosy at all, in fact.
Yeah. So you know what I mean. It's a typical thing. They will obviously, they have a shareholder base to protect, so they will obviously make very conservative statements. Infosys has been actually being very conservative for the last 1 year, and it's actually coming out. You've seen that view playing out. My sense is that it's like rate of change. So the rate of change of negative is coming off. So you'll see that at least the US economy is rebounding. That is there for you to see and for me also to see. That will have an impact on everything, including IT spends. You may have an impact with a lag, but the point is there will be an impact. For all you know, earnings might not get impacted, but multiples will, because multiples will price in an upgrade cycle before the earnings actually improve.
So what is a clear buy in the IT pack then?
Infosys. We like Infosys.
Why not TCS or Wipro?
See, we also like Wipro, incidentally, but in TCS, for example, we think the street expectations are still very optimistic, and that company has started guiding negatively or cautiously just 3 months in. Let it do that for some more time. So we think in TCS actually earnings estimates will continue to get paired for some time. And in Infosys, you might start seeing an upgrade cycle later during the year.
That's an interesting point, because TCS is one company which so far has surprised on the upside.
Correct.
And Wipro and Infosys are two companies which have surprised us on the downside. You see the reverse happening now.
Yeah, so it's time to play the trade the other way around.
In the month of December, you were bullish on rate sensitives. Thank you for that call. Good call. But is the trade in rate sensitives now over?
I don't think it is. I think, it's like this, that if at that time I told you buy the highest beta in December, I said buy the highest beta. So in the overall PSU bank index, I'd buy the smallest PSU bank. Say for example Dena Bank, and Dena Bank actually doubled in like 2.5 months from there. Today again banks have corrected. I'd say now don't buy the highest beta. I would say buy the more quality banks, but still play the trade. I mean, I don't think the situation has come us to take a blind view that interest rates will keep falling like 125 basis points all through the year. I don't think that view is there. I think money needs to be cautious on the pace of the interest rate cuts. And so, while I think the whole sector will do well, I think now quality might outperform. So I'm looking at, so today I would say, look at an IndusInd Bank, look at an ING, look at a Yes Bank over a Dena Bank or a UCO Bank. In the PSU bank space, look at an SBI. So I would say look at an SBI, look at a BOB, maybe look at a Union Bank also. So I mean, I look at these kind of banks over the absolutely high beta trades.
What is the biggest risk for next 6 months?
Oil. It is oil. only oil. So if oil spikes up, it's game over for some time at least. That is what, if I worry about something, that's all I worry about.
Are you fundamentally bullish on crude or bearish on crude?
I'm bearish on crude. I think, we've just had commentary yesterday from a minister in Saudi Arabia saying that Saudi can raise its output by as much as 25%, and there's no issue of supply. I think that he's right. So the issue is that this it's not reminiscent of 2008 when oil spiked up to 140, because at that time the demand was very, very strong. You have a Europe which is, today if you look at the situation of the globe, a US is recovering, a China is floundering, a Europe is just finding its feet, emerging markets are just finding their feet. The demand environment is nowhere near what it was in 2008. And so you'll in all probability, I mean the move on oil, if there's a steep move in oil, the move will be downwards rather than upwards.
If I map this year's price action, equities and commodities, they moved in a synchronized manner. Bonds also have participated, and precious metals have also gone up, and with cheap liquidity. But
it's amazing. Sustain? It's amazing. Actually, it's amazing. Everything is moving in such a highly correlated fashion.
It's rare.
It's very rare. I agree with you completely, and so which is quite surprising actually. I would be more bullish on equities than on commodities. I'd be more bullish on equities even than precious metals. So I would, I think this should be a year of equities. I think that this year, because of the strong liquidity support that will come from the US and EU, you will see it flowing into emerging market equities, because those equities are priced for a very attractively priced. These countries have significant central bank reserves to be able to prime economies. So that is a big trigger for these markets over the next 18 to 24 months. So I think money will find its way into emerging markets.
Are we somehow getting too convinced or too naive to assume that liquidity is here to stay? Because similar assumptions were made after QE2, but QE2 clearly backfired, for a market like India at least.
So the issue is that whether in a time where QE2 backfired, because at that time the whole world had raised its fiscal deficit by 50-70%, and so there's huge spending, a huge economic revival in the world, and which is why QE2 backfired, because that's what you saw commodities jumping up massively. This time around, I don't think that's the case, because every country, including the US, needs for oil prices, for example, to remain low for the economy to recover. So I don't think this time around the world dynamics will play in such a way that to foster a bull run in commodities. I'd be more circumspect on that, and I'd bet on equities. I mean, anything can happen finally, but the point is, where do you think there's higher probability?
So in terms of risk versus reward, you would say go for commodities.
I said go for equities.
Go for equities, I beg your
pardon. Yes, I would do that.
When we started the year, the basic assumption was that in the current calendar year, which is FY12, Indian markets will appreciate by 15 to 20%. We've already appreciated 15% in the last 3 months. Do you think for the rest of the year we will now consolidate? Yeah,
so you might see I think there'll be some action around the rate cut, and then you might actually consolidate for a while. I don't think you're appreciating 15-20% more from here. For that, you would need crude to come off. So then the view is on crude. So the rest of the view is that suppose crude goes to 140, then you might actually depreciate by 15%. That might also happen. So if crude stays around 115, 120 levels kind of thing, then you'll see a gradual rally in the Indian markets. But I think you'll see a trading rally around the time that the RBI is starting to cut interest rates.
So what are your top ideas for this calendar year?
They have actually, given the price performance, a lot of it has changed. So today,
at current levels, let's say if you have to construct a portfolio which you don't want to sell for next 3 years, and which you think would give a 25% CAGR return.
So one clearly is I'll put large and mid cap separately. So I'd say on the large caps, one is clearly ICICI Bank. I think that stock will do very well. I'm still a diehard fan. Second, I think I would bet on Infosys, which I think would deliver, and third, L&T.
Anything from the mid-cap space now?
So I would look at small banks. I'd look at ING Vysya Bank, because that's a bank which we really like. Petronet LNG, I think will still do well. And the Jaiprakash Group. I mean, there are 3 companies there. So one of all the 3 companies put together, I think you can have a serious rally there over the next 3 years.
Do you think the outcome of UP election could have an important impact on the JP Group?
These things only have transitory impacts, as you are very well aware. Eventually, everything gets fixed.
So what do you like about the JP Group? The fact that they have a large cement business, or they have Apart from cement, couple of other interesting assets also.
Actually, the attraction is all outside cement. I mean, they have a very strong a bouquet of power projects, and which are very viable. The hydropower business is a very good business. The road, once it gets built, and you'll see the whole house, it'll become one of the largest real estate developers in the country, given the amount of square footage it has in under development. Is that the road has to get built, they will take a loss once for the road, and then life will go on. Cement business, I think there is, and I'm sure the management has also spoken about it earlier, but there might be the possibility of a deal there. So that a deal there will deleverage them significantly, and will actually be a very positive for that group.
So the script of how Indian markets have moved in the year 2012, that was largely dominated by global liquidity. What do you mind could influence the script for next 6 months?
So I think it's about the way the Reserve Bank acts. It'll be commodity prices. It'll be inflation, actually, as to how inflation plays out. Because I don't think anything else really matters. I would also say, to add to that, in the budget, for example, while there have been a lot of statements about reform in the budget session, so I think it would do good if the government were to produce action on a few fronts, for example, like the GST or an FDI in retail, or the others like the Land Acquisition Act, and finally fixing coal for the power projects. If they're able to put all of this together, then that can also be a very big trigger for Indian markets.
When we started the year, the popular trade was to sell consumption, sell FMCG, sell defensives, buy rate sensitives, buy some asset owners, and buy some motors.
Correct.
Rate sensitive stocks have done well. Do you think that trade in rate sensitives, or the delta trade, is now over?
No, I don't think so. That's why I said, I think at that time the point was, since you see a sector rally, buy the one with the highest beta. Now I'm saying I see a sector rally, but I see a tepid sector rally. So I'd rather buy the one with quality rather than one with high beta.
How do you propose one should approach consumption stocks now?
Yeah, so since there is uncertainty still prevalent, I don't think those stocks will underperform. And I have seen the way what's kept the India economy growing in the last 18 months has been consumption. I think one needs to think about it very differently. The whole attitude of the Indian consumer has changed, and now the attitude towards consumption has changed. So if India becomes a consuming economy, you have these stocks we may do well for years on end, and you will see these stocks remaining expensive. You might see rallies at significant points in time after time corrections. So you're in the face of a time correction which will eventually end, and then these stocks should do well. So I'm not negative on consumer stocks just because they're expensive.
Service tax has been increased, excise duty has been rolled back. Do you think Indian consumer will start slowing down? If not in this quarter, maybe after 2 quarters?
If you look at the wage growth, it's also very strong. There's been the highest year amongst the best years for wages growth. So then I don't think so. I think the duty hikes are not as much as, because see, the consumer's perception still is that these are all transitory and not permanent. Because the government has a issue on the deficit, so the urban consumer will be aware of this reality, and nobody will take a view that this is going to be life as going forward. So if you are at the verge of an economic revival, your wages, your incomes are growing, I think that's where the mentality shift has happened. That is, as long as incomes are growing, my propensity to consume will still be high.
So what is the tilt within the consumption space? Do you like urban-oriented businesses? Do you like rural-oriented businesses?
So I think for the next 12 to 18 months, I would like to go towards more urban-oriented businesses rather than rural-oriented businesses. Because
so no two-wheelers, no FMCG?
Yeah, I would prefer the urban ones.
What are typical urban ones which you like?
No, we basically like levers and ITC. I think those two stocks will do very well still. They'll continue to outperform. I did not put them in my 25% CAGR because I don't think the stocks will compound at that level, but I think they will outperform.
What are the sound bites you're getting from some of your top institutional clients? Are they of the view that yes, Indian markets have appreciated, but we still want to be with this market because there is sign and signal of a turnaround happening here?
I have never seen a more confused investor base. Never. I've been in this industry for now 15 years. This quarter, people have been hit and they don't know what's happened. And it's like almost that when the whole rally happened, nobody could participate in it, and people were extremely bearish, not bearish, but extremely bearish. And the market behaved exactly in the opposite fashion.
Has the opinion changed now?
So once they start getting bullish, again the argument has changed. So again they are pretty confused. So my sense is that is why nobody, you'll just see liquidity driving the market. I don't think people are taking directional calls that, okay, I think rate sensitive will do well. Let me. So everybody is playing plus and minus. So if you have a index, you'll be plus plus delta on rate sensitives and minus delta on, say, on commodities. That's how you'll play it. You'll not take a very aggressive bet either way. So I don't see any investor taking very aggressive bets.